On this week's Emily Now episode, we're going to be talking about refinancing commercial mortgages, the fees that are involved with commercial mortgages, as well as walk through an example of a business that refinanced a property that they owned to be able to pay their bills off. And I'm going to spend a little bit of time talking about what would happen if interest rates went up and how it would affect you and your business. So stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. I've been a finance guy for the past 18 years helping people and businesses with the mortgage or loan that they need. And we put these Emily episodes together every week to try and help you understand some of the mortgage and loan issues and topics that we think might help you be able to make a better decision to do more. We feel that debt is a tool that you can use to do the things that you need, and with the extra money that comes from the success that you experience, that you'd be able to save for the future, invest in new opportunities and into the market around you, as well as maybe give back to the local community around you. So we enjoy putting these together for you. We hope that you find the information valuable. It mirrors what you would find on our website at mlenow.ca, which is an online platform that helps you connect with the banks and lenders that can approve you. We have a unique scoring system that we put together to make it easy for you to understand your options before you talk to a broker, a banker, a mortgage specialist. So we would encourage you to visit mlenow.ca and check that out. You can also follow us on Twitter, Emily Now Canada. You can like us on Facebook. You can +1 us on Google, and hopefully you can subscribe to us on YouTube so that you don't miss any of these episodes. In each of the episodes, we go through a few questions that have either come across our desk in the past week, come to us through social media in an attempt to try and help you understand some things that you may want to know about. And our first question today is, can I refinance a commercial mortgage? And the answer is yes. Interestingly enough, many people believe that commercial mortgages somehow are a little bit different than maybe the mortgage on their home. And while that's true, refinancing it, many people are surprised to learn that they can refinance a commercial mortgage. Now, the penalties are larger, of course. So if you have a home and you've ever refinanced the mortgage on your home, you would know that there are sometimes penalties that are incurred, certainly an interest rate differential, an IRD, or maybe 3 months. But in commercial mortgages, the same principle applies. But refinancing a commercial property is a great way to free up some cash. The standard amount of money that you can refinance on a commercial mortgage is about 65% of the value. But if your business occupies the property, so this is a building that your business operates out of, or operates out of more than 50% of the available floor space, then you may be able to qualify for more than 65% of the value on a refinance. The amortization period is on average about 15 years, but again, depending on the bank that you use or the credit union that you chat with or the lender that you might be working with, they might be prepared to give you a longer amortization period than that to allow you more time to pay back the mortgage. As it relates to amortization periods, it's important to know that many times the bank will want the amortization period to be less than the expected life of the building. And so if you have a commercial property, you might have to get a mechanical report or a structural report, or have some way, the bank will ask you for some way to prove what the expectancy of that building will be, or what's the life left in that building. And if it's 15 years, then you might find that they'll give you an amortization period that's slightly less than that. If it's 30 years, then they're probably more than happy to give you an amortization period of 20 years or 25 years. So just a little sidebar, make sure that you do know what the expectancy of the property is. How long will that property be in good health for, if you will, and then you can line up your amortization accordingly. Because you are going to be refinancing the mortgage, one of the big considerations to make, of course, is that you're now going to be paying interest again over a new amortization period. So kind of mortgages 101. An amortized mortgage is a mortgage where every payment that you make, a little bit goes to interest, a little bit goes to principal, and over time, the amortization period, you would have fully repaid that mortgage. And so the first half of an amortized mortgage tends to be mostly interest, and by about the halfway mark, it starts to be, each payment starts to become mostly principal. And so if you're looking to refinance and reset the amortization period, so maybe you ended up buying a building a few years ago, you were making payments, it was done on a 20-year amortization, and now you want to reset that amortization and put the mortgage out over another 20 years, you're basically going to be paying a bunch of interest for that. So if you need to refinance your commercial mortgage, make sure that you know what the cost of doing that is, and that it is truly a cost that you're prepared to pay. Now today, in our interest rate environment, it's many business owners or many commercial property owners will say, well, because interest rates are so low, I don't have a problem re-amortizing the mortgage. I have tenants that are paying the rent, or as a business, I know that our business is going to be able to continue to pay this rent for many, many, many years to come. So having the cash is more important than paying the interest over time. So those are just business decisions to make, but make sure that you're aware of them so that you go into the transaction knowing what you're signing up for. We have some examples of people that have done this. We know that there are seasonal type businesses that end up refinancing their commercial property to free up cash for their off season so that they can pay for their operating costs during a downturn. We know of some businesses that have come through mlenow.ca where they own maybe a little commercial bay, and there was maybe some receivables that they didn't get paid on. So maybe they had done a big job for a few of their customers, but the customer ended up not paying them, or for some reason experienced some financial trouble, but they've been carrying the costs that were associated with that project. So they had to pay for materials, or they had to pay for the labor, expecting that when the job was done they'd get paid, and because they didn't, they took that cash to pay for those things out of their business. And so refinancing their commercial property allowed them to take that equity they had, put it back into their business, and fix the cash flow that they had. Some people refinance to pay for things like GST, believe it or not, taxes, and so again, a commercial piece of real estate is no different than a residential piece of real estate, and it's a great way to access the equity if you need it, and certainly there's lots of options for it. So we'd encourage you to jump on mlenow.ca if you are looking to refinance your commercial mortgage. Once you jump in there, you can drop in the mortgage amount that you're looking for. It'll ask you a few questions, and then it'll show you what's going to be required. And ultimately, when you sign up for an account, you will be able to connect, send your information directly to the banks and lenders that can help you, or you can send it to us and we can help you with that as well. So our second question today is, what are the fees involved in a commercial mortgage? I can't tell you how this topic really rubs some people the wrong way. Fees are certainly a very popular topic. There are quite a few different fees to talk about, but the two main ones really that you should know about are bank fees and broker fees. And I'm going to spend a little bit of time talking about broker fees and bank fees, because this tends to be where most of the friction comes when people are considering getting a commercial mortgage. Now, what most people don't know, if they've never borrowed commercial financing before, is that banks do charge fees. They'll charge you 0.25% all the way to 2% of the loan amount that you're requesting, be it a mortgage or a loan. And they do that because these mortgages are they take a lot of time. There's work that's involved in approving a deal. So when you look at a residential mortgage, it's sort of widely accepted that there are basic criteria that all of the banks will use to determine whether or not you can be approved. And so because residential mortgages are such a highly commoditized business, the marketplace has really great ways of being efficient at getting you that approval. But when it comes to commercial financing, those same efficiencies don't exist. So if you're looking for a commercial mortgage and you had a package in your hand and you went to Bank A, Bank B, and Bank C, you would probably find that all three of them would respond differently to your request. They would have a different timeline for responding to your request, depending on the type of property or the industry that you might be in. You might find that the pricing is significantly different between the three of them, the interest rate that they're prepared to offer you. But the fees also would be different because each of those banks are going to have their own internal representatives or individuals that work for the bank that have to look at that information. They have to determine whether or not it fits the credit criteria of that particular bank or lender. And then they've got to spend time now trying to get it through their credit department. So the reason that commercial mortgages and business financing requires fees is that work that's involved, the people that have to do that work, they have to get paid. They're not commission driven or primarily commission driven. They are salaried, but even if it wasn't their salary, there's infrastructure that is involved. So the bank branch or the business, or rather the lender that you're looking at, they have offices and they have to pay for the lights and the utilities and their staff. And so they can't afford to not charge fees for putting that financing together because in addition to not being a very efficient marketplace, the other challenge is that most banks and lenders have to look at dozens and dozens and dozens of requests before they can finally commit to one and approve one. So they have to spend time on lots of files and hope that a few of them end up working out, but they do charge fees for trying to understand whether or not to approve you. So much like brokerage fees, where the same mechanism is at work, where brokers tend to work more on contingency, meaning that you're going to pay a broker once they've been successful at finding you financing. But the broker fee and the lender fee are not the same. They're very separate and they serve very different purposes. But yes, there are fees involved. Those are the two most popular ones that tend to cause people the most angst, and you should know about them. It's important to know that ultimately the reason that you pay fees are for the time, knowledge, and access to the money that you need. So it takes time to get an approval. It takes knowledge to understand how to give you the approval that you need based on the security that you're offering, based on your particular situation. And quite frankly, you're paying for access as well. If you just imagine it on a very simple basis, if every bank has a handful of people that are looking at loan requests or mortgage requests, and they're getting flooded every single day with people looking for money, there's only so many approvals that they can give out every day. And so part of the reason that you pay fees is to be able to get access to the people that can ultimately approve you. So whether you're paying a broker for that, to access to a bank, or you're paying a banker to get access to the credit department, ultimately that's what the fees are meant to pay for, the time, knowledge, and access to the approval that you're looking for. Of course, there's other fees that you should know about that are not necessarily unique to commercial mortgages, but they include appraisals, legal fees. There's sometimes some accounting fees that are required. You might need an environmental report, and so there might be some engineering fees. Because of the work involved, again, these fees are required and they are part of the cost of the transaction, so you should know what those are. You should always ask why you're paying the fee. You know, if you talk to a banker, just ask, you know, why are you guys charging me a fee for this? Or if you're talking to a broker, what am I going to get for the fee that I'm paying you? What's going to be your deliverable? And I can't tell you the right answer that you should look for, but it should be an answer that makes sense to you and something that you feel comfortable with. Just countless examples of people that go to the marketplace, they knock on all the bank doors and they say, look, I'm looking for money, and then the bank says, okay, I think we can help you, but do you have a package? Do you have anything to show us? And they say no, and so then they go to the next bank and they kind of hear the same thing. So anyway, they're trying to save themselves the cost of maybe the broker fee, or maybe they're trying to lessen what the cost of the bank fee is, but at the end of the day, they don't really know what they're asking for. And so we encourage people, obviously, to use mlenow.ca to, at least before they start knocking on doors of banks, understand what questions are going to be asked, what documents they're going to need to have, the math that they're going to have to prove, the basic math. Because if you can't do those things, then you're just wasting your time, and you're going to probably end up paying higher fees for not being prepared. And that's probably true of many things in life, that you pay more if you're not prepared. And so in our little way, we're trying to help you with that, with financing at mlenow.ca. So we'd encourage you to try that. But yes, commercial mortgages involve fees, business loans involve fees, banks charge fees, and and that's just the way it is. So make sure if you're going to pay those fees that you know why you're paying them, how much you're expected to pay, and when they're due, because some banks want to see you pay those fees before they give you a commitment letter, or at least ask for a deposit on the fees that many times can be non-refundable, or only half of it is non-refundable. So hopefully that helps you out a little bit. I'm going to talk about a real-life example of a real estate developer that is both a developer and a builder, and had to recently refinance some of their commercial property holdings in order to free up cash to continue working on a development that they've spent years putting together. And they've run out of cash, but they haven't run out of cash because they are not good at what they do. It's sort of the nature of the beast. When you get into land development, land positions, they can be tricky business, depending on the mood of the market, depending on the mood of the municipality or the government officials that you have to work with in order to get the development approvals you want. There's just lots of things that can get in the way of you getting your land to the marketplace on a timely basis. And so in this particular case, this particular company has a history for more than 20 years of building homes. They've been very successful at it. They're not quite a production builder, doing hundreds of homes a year, but they're certainly not a custom home builder in that they only do 1 or 2 a year. They're probably somewhere in the middle. And they've been, over the years, the money that they've made on building homes ended up naturally evolving into becoming a developer and buying land positions. And to buy those land positions, they took some financing and then got to work on putting the engineering work together, working to get the permits and the approvals that they need. But in this one case, the permits probably took 3 years longer than they had expected. It's a well-located piece of land here in Calgary, Alberta. The owners of this land started years ago putting the area structure plan together with the municipality so that they knew what land they had to work with. But then, because our city has experienced such amazing growth in the last few years, the city went and changed their approval on them and asked them to go back and do some more work on some of these key items that needed to be addressed. And so all of that cost money. They have to pay interest on the mortgages that they have on the land. So because land doesn't generate any kind of income at all, they have to look to their other real estate that they have, free up the equity or take the equity out by getting new mortgages on it so that they can pay for the costs over here on the land. And this is pretty common. We find that many businesses in particular that own property will buy it for this reason. They will, when times are good, they'll take their cash, they'll lock it up in real estate, they'll get financing on that real estate and pay it off over time. But when the time comes that they need to free up equity or they need to pay off some large bills, their real estate is the first place to access. And the reason why that's important to know, even if you're a business and you're planning the future, buying commercial real estate is something you might want to consider for this reason. But refinancing a commercial mortgage can be, to get money for your business can be a lot easier than applying to the bank for a business loan. First of all, commercial real estate has real value, it's tangible. Whereas if your business needed money because you have a gap in maybe your payables and your receivables, the bank is going to go through a different underwriting process or a different approval process to figure out whether or not they can give you that money. But if you have an asset, like a piece of real estate, it's quite simple for them to value that real estate, give you a percentage of it, 65%, 75%, and you might find that the approval goes quite a bit faster. So in this case, they were able to leverage some industrial real estate that they had. The money is going to flow into this land development that now looks to have some traction, and again, a perfect use case for financing and for a business that was able to look ahead and in their good years accumulate assets that they knew in their down years they might have to leverage to carry them through, but they were able to do that. And so there's a real life example of of somebody that was able to refinance some commercial real estate and use the money in a different area. I was reading through the news, as I often do, looking to put these segments together, and I came across an article that said Bank of Montreal recently stress tested Canadian households to see what the impact of a 2% interest rate increase would be. And I guess the results were that if interest rates went up by 2%, more than 50% of the households that they talked to could still afford their life, could afford their home, their mortgage. It wouldn't be a big problem. 20% of the people that they talked to said that they couldn't afford anything. In fact, if the interest rates went up by 2%, that would probably really have a massive financial impact on them and their family. And 23% of them said they didn't know what would happen if interest rates went up by 2%. They didn't have any kind of contingency plan for that. They didn't know what the result would be if it did happen. So I got thinking about this in the context of if you own a business and you have commercial financing, could your business survive a 2% increase in interest rate? And as I get thinking back through the businesses that we've worked with over the past years during this incredibly low interest rate environment, there were a few things that became apparent to me, which was, first of all, many private businesses, and we define that as they're not publicly traded, they have less than 500 employees, so they might be small businesses or medium-sized businesses, but they're private businesses nonetheless. Many of them don't really consider the cost of financing when getting it. In fact, most of the times that clients are jumping on mlenow.ca to request help for a business loan is usually because at the 11th hour. There's been a critical event or something that's already happened. They didn't get paid on an invoice. Or maybe their business now, the partners aren't getting along and it's gotten to the point where someone just said, look, I'm going to buy you out. So many times the point at which we get involved with businesses is at a point where the cost of financing is less of an issue and simply getting their hands on the financing is the key. And so could they withstand a 2% increase? I think the answer would be sure they could, because many of them aren't really thinking about that. They tend to be pretty ambitious and they know what they can and cannot do, and so they'll tend to take the financing at any cost. I know of businesses in the past couple of years, since the downturn, certainly in 2008, where businesses are paying double digits for their debt. So they're already paying 2 to 3% a month for factoring or accounts receivable financing, and the providers of that money, they don't really price their money according to prime. So, the fact that the interest rate might go up by 2% a year, would be very negligible for these private lenders that are charging 24 to 36% a year, and businesses are paying it. Now, I put a bit of a caveat in there in that many of those businesses that are borrowing that money at those kind of interest rates, they're only using the money for a short period of time, so they tend to be factoring an invoice. So maybe the longest period of time that they're paying interest for is 60 days or 90 days. And so when I say 24 or 36% a year, that sounds like a really, really big number, but they're only borrowing it for shorter periods of time. That's the annualized rate that they're paying. But the real cost on a per day basis, they end up usually just passing on to their customers. So many businesses can find a way to cover that cost quite easily, but it is important to know that 2 to 3% is still 2 to 3%. Profit margins, from what I see on a daily basis, profit margins aren't really, really thick in many businesses. In fact, I would say that many businesses since the downturn continue to operate on a very, very lean basis. They're efficient. Technology has helped make all of us more efficient. The cost of their labor has gone up, certainly in our city, in our province. And so the margins are still very thin for a business, and if a business is paying 2 to 3% a month, hopefully they're only doing it for a period of time and ultimately moving away from that or fixing the problems in their business so that they don't have to keep borrowing that money. But a 2% increase I don't think would affect many of the businesses that we end up interacting with every single day. Prudent businesses, of course, they plan their resources and they steward them well. They will look into the future. They'll say, here's what our business is going to do over the next couple of years, and they'll sit down with a company like ours, go through a website, mlenow.ca, and try to understand, okay, if I need money, and if that's the kind of income I need to generate to pay for that money, how are we going to do that? What's our business strategy? So they'll have a plan to help them understand how to make adjustments to their operations, to make adjustments to their finances as the market changes. My thoughts would be, because interest rates are so low, you have one of two options right now. If you're carrying a bunch of debt, and if you look at your balance sheet, and I know lots of businesses like this, they have high rate debt, they have low rate debt, and between all the debt that they have, it's probably kind of low teens or high single digits, that today is the day to refinance that stuff, consolidate it, and pay it off quickly, because the cost of capital is very low today. Or if you know that your business is going to grow and expand, borrow money on a term basis and make sure that you've got a plan for paying it off by the time the term is over. And it's a great time to be borrowing money. The misconception is that banks are impossible to get money from, and the truth is they're not. You just have to know what you're doing. And so to that end, we would encourage you to visit mlenow.ca, where you can see what's required to get approved. In fact, not only can you see what's required, you can see all of the banks in the marketplace. We have scored them for you, so you can take the score that you get at the website and you can match it up with the score of the banks and try to make the connection to see what options you might have. But in addition to that, you can see the interest rates, you can see the money you're going to have, the monthly payment, the documents, the questions that you're going to be asked, sort of all of it. And so we would encourage you to do that if you're looking to borrow money. And in this low interest rate environment, it might be something to consider, to not keep pushing down the road, because one day I don't think interest rates are going to be this low. I don't know what that day is. I've been saying for years that I thought it was going to go up, but it hasn't yet. So that just goes to show you, we just never really know for sure. But we thank you for checking out this Emily Now episode. We look forward to seeing you next time when we continue talking about the mortgage and loan topics that should be able to help you do more if you had the answers. So we'll see you next time.